and welcome, Chris.
Andrea, thank you. And that's a tough act to follow from Martin, so I appreciate that as well. Thank you all for making time for me today and for the invitation. Very much appreciated. As Andrea says, my name is Chris Lorne. I lead the public sector practice for Aon. I'm joined by my good colleague Jeff McIntosh, who's one of the senior account executives in our Toronto branch. We only handle public sector business. That's all we do. We live and breathe it every day. As boring as that might sound, that's what we do. I'm just going to share my screen with you. Just give me 1 second. Here we go. So can everybody see my screen okay? Maybe just a thumbs up or something. Good. So before I get started, I've got some slides. It shouldn't take me too long. I've tried my very best to take out insurance jargon, keep this as high level as possible. But if there's any questions, anything that I don't explain very well, please ask. There are no stupid questions, unless, of course, I don't know the answer. But just jump in, as you deem appropriate. So with that, I'll get going. First of all, I'd just like to acknowledge first that I'm joining this meeting from Treaty 7 territory, the traditional territories of the Blackfoot Nations, including Siksika, Piikani and Kainai, the Tsuut'ina Nation, and Stoney Nakoda First Nations. We acknowledge all the many First Nations, Métis and Inuit whose footsteps have marked these lands for centuries. So moving on, what is a reciprocal insurance exchange? You've just heard Martin give some of the options available to municipalities. So today I'm just focused on a reciprocal insurance exchange. So first and foremost, it is a fully licensed insurance company. It's regulated like other insurance companies in Canada, but uniquely it's designed for members with similar interests to share their risk. So it only works for homogenous interests. So you couldn't have, for instance, a municipality and a sawmill. It has to be like-minded individuals and municipalities. Also, it's owned by its members. So it's not owned by shareholders and bureaucrats. It's owned by ultimately you guys as subscribers to the reciprocal. It's defined in the Insurance Act as a group of subscribers exchanging reciprocal contracts of indemnity or interinsurance with each other through a principal attorney in fact. One thing to point out, and you may or may not be familiar with reciprocals or have experience with them in the past, but it's a very well established and legitimate way to retain and transfer risks, or insurable risks at least in Canada. And they were founded as a response to very difficult market conditions, similar to where we find ourselves today, due to uneconomical pricing, lack of capacity, or perhaps too much volatility too. So that's ultimately where reciprocals were established back in the 80s, again, as a response to the lack of available or unaffordable capacity in the insurance market. So why now? Why might this be a good opportunity for NOMA at this part of the market cycle? So as I say, first and foremost, traditionally reciprocals were here for that very reason, to help provide capacity affordably for municipalities in difficult market conditions. It can be a more efficient way to pay high frequency, low severity losses. Traditionally, insurers will collect about $1.60 for every $1 that they pay out in claims. So they want $1.60 in premium to pay for the $1 that you're having in losses. Reciprocals can do that much more efficiently, much more cost effective. Generally speaking too, reciprocals have a lower expense margin, on average around 10%. To compare that with the regular insurance industry, we're looking at 30%. So again, it's where you can find savings just by being smaller, more nimble, more efficient in how you transact your business. Also, you can utilize your own in-house claim staff. So again, having local knowledge of your communities, of your municipalities, that will help. And again, not paying insurance claims staff and all those kind of expenses. But also importantly, especially in more remote areas, you can utilize local contractors at discretion too. So keeping funds in your community, using people that are available, boots on the ground that know how to get to where they need to get to. The insurance hard market that Martin referred to, those conditions have likely peaked. We don't suspect they're going to continue to deteriorate, but they've probably plateaued for a couple of years at this point. Hard markets turn into a hard market really, really quick. You'd have seen that 2 years ago. Suddenly, the hell's opened and you saw the impact in insurance. It doesn't soften at the same pace. It happens over drip, drip, drip over 10 years or more until it reaches the bottom, and then it will correct really quick, and then will soften again really slowly. So I suspect we've crested the wave. We'll still see increases, but we might start to see some reductions in some rare cases, but we'll expect to see some stability at this point. In a hard market, reciprocals have other tools that other municipalities do not have. One of the main benefits is access to other forms of capital. So for instance, you can access the reinsurance market. As a conventional insurance buyer, you cannot access the reinsurance market. Reinsurance is insurance for insurance companies. Reciprocal is an insurance company, so you can use reinsurance. So your available capacity increases significantly, so it gives you leverage. But also, again, after a few years, if you've been running the reciprocal successfully, you've built up enough equity, you can then use that equity to kind of mitigate and reduce the impact of increased premiums in a hard market. So you can start to use that rainy day fund, if you so choose, to soften the blow of the hard market cycle when it comes. But also in a soft market, reciprocals generally find it a bit more difficult to compete. That's just a feature because, again, prices get compressed. But they do have other levers to pull on. So for instance, if you fund your reciprocal to a certain amount, in a soft market, we as brokers can negotiate and we can potentially reduce that. And we have experience with another large municipality about 2 or 3 years ago, where we were able to reduce the reciprocal amount by $1 million. So that was $1 million saving for their membership. We couldn't reduce their premium by $1 million. It wasn't that big, but certainly the reciprocal component, we could negotiate with the market and we reduced that by a very significant margin. One of the important factors, we're looking at NOMA and its membership, generally smaller municipalities. I know Thunder Bay is there, obviously, but generally a group of smaller municipalities. Whether it's a hard market or soft market, smaller municipalities generally have very limited options for different reasons. Minimum premiums become an issue. There's just a lack of market interest in municipalities that are not risk managed. In other words, they have a risk manager on their staff. But also you're exposed to increased volatility. So if you're a small municipality, one large claim can wipe out your loss ratio, your profitability calculation for many, many years. And that insurers will see that for a number of years into the future. At the same time, now compounding matters. Insurers have very much moved away from writing business where there's lots of attrition. It's too much of an admin burden, too much expenses, too much cost. So accounts that have lots of high frequency, low severity losses, insurers are moving away from that. Our reciprocals are a really useful way to bridge that gap and act as that first insurer, manage those claims more efficiently, as we mentioned, and just use the insurance market for those severity losses. So it's a good meeting of the minds, essentially. I've captured on this slide, perhaps before I do that, I just have any questions, anything you'd like me to expand upon before I move on? Sounds like a no. I'll keep going. So I mentioned in the first slide, reciprocals are a very well-established feature of the insurance market, but especially in the public sector space. So I've included some of the municipal reciprocals that exist today. So in BC, you've got the MIA BC. In Alberta, there's 2. There's RMA and the AUMA. Saskatchewan has 2. Suma Shore, which is for the urban municipalities, then SARM, which is for the rurals. In Nunavut, we've got NAMIX. In NWT, we've got NWTAC. Then in the Yukon, we have the AYC, the Association of Yukon Communities. Aon is the partner with all but 2 of those. So again, we know this space very well. In the education space, a very similar story. Lots of reciprocals for school boards and for colleges too. Healthcare, there's the HEROC reciprocal for hospitals. Most of these have been established for well over 20 years, collectively insure hundreds of billions of dollars of physical assets, and of course, citizens against claims and all the slips and falls and those kind of things. So this is not a new thing. This is not a new idea. This is very well established in the public sector space. Lots of success stories to call upon and some lessons learned too, to be fair. But again, this is very much a feature of the public sector space when it comes to insurance. On the next slide, and if you forgive my PowerPoint and Excel skills, I tried to show a comparison between a conventional structure, so the type of insurance that you buy today, versus what a potential reciprocal structure could look like in the future. So, if you're a municipality today, on average, you may buy $25 million of liability limits. So you'd have your deductible, the box in the green, maybe have a primary 5 million limit, and then an excess on umbrella 20 million on top of that. So that's a very conventional structure. And if you buy more or less limits than that, it doesn't really matter. It's just for illustrative purposes. That's how most munis buy their insurance today. If we look at a potential reciprocal structure, we still have your member deductible. So everybody would still have the $5,000, the $2,500 for the regular stuff. The reciprocal could, for instance, so again, don't worry about the numbers per se, I'm using it just to make the point, but the reciprocal could say, we're going to pay the next $100,000 of every claim, but once we've reached $2 million in the aggregate, that's when the excess insurance comes in. So the reciprocal could pay the first $2 million of all the claims, broken down on a per occurrence basis, and then use the insurance or reinsurance market to maintain those same limits that you had in the past. We have many reciprocals that buy their insurance on a very, very similar structure to this. Alternatively, though, again, I mentioned that reinsurance is an access to capital that most clients would not have. Reciprocals do. So again, I'm aware that there are a number of reciprocals that only use reinsurance. There's no better or worse. No better or worse. They both have the benefits, the pros and the cons. But you could use all of the reinsurance market too. It's structured a little bit differently behind the scenes. Now, if you look at the orange and the green columns, that rows there that I've highlighted, that's where most of your claims occur. So your slip and falls, your burst pipes, your break and enters, your vandalism, they're all going to fall within your deductible, and then that kind of attritional, that high frequency amount. And for the sake of argument here, we said 2 million. That also means that's where your premium is allocated by insurers. So again, when they're pricing it out, if you ask them to quote for 2 million, the premiums would be quite high versus the excess 23 million that we mentioned. But again, going back to what we said earlier about the efficiency and how reciprocals can handle those claims better, that's where you're able to drive the premium savings potentially. And I do reiterate potentially in this layer here, because that's where you control that premium, you control those claims. So I've captured some of the pros and cons. Now, you may see these to be from a different perspective. You may see these as being cons where I say the pros and vice versa, but this is just some general observations just to kind of give a high-level overview. So some of the advantages: ownership, self-determination. NOMA would have their own bespoke reciprocal built entirely for the benefit of your membership. Within that, though, you're sharing risk with like-minded members, so you know that the only people that subscribe to the reciprocal share the same views that you do when it comes to claims and premiums and sustainability. As Martin mentioned, and I very much agree, it would give you increased buying power simply due to the scale. As we mentioned, many of your members wouldn't be big enough by themselves to attract multiple options from the market. You might be left with one, maybe two options. The reciprocal changes that dynamic significantly. And it can help to reduce your insurance premiums. And again, can, not will, I have to reiterate that. All depends on how it's managed. But again, we've shown some examples of where you can use simply better expense ratios, efficient claims paying process, keeping that in-house, using local contractors and so on to help reduce premiums. One of the big benefits, as we've mentioned a couple of times, access to different forms of capital, reinsurance being one, the London market, Lloyd's of London. Again, some of your members wouldn't be big enough to be in the London market. Others would, but as a reciprocal, you definitely would do. The more capacity you can attract as a risk profile, the more leverage you have to negotiate premiums down. So it's a lot of leverage. Reciprocal is also, again, because it's your own insurance company, it's your own vehicle, it can provide a means to insure assets or exposures that are traditionally undesirable in the insurance marketplace. So I've shown cyber right now. Cyber might not be the best example, but I know it's a pain point for municipalities. So it's potentially an area where you could say, we'll just bring in some cyber insurance into the reciprocal to make sure that our members have some protection. It's possible. One of the main attractive points for reciprocals is that any profits that you generate, they're yours. They can be shared back with your membership. They can be used to grow the reciprocal. They can be used to reinvest in risk control and risk management. Again, Martin touched on those. instead of all those funds staying with the insurance company, you never see them. So remember that 2 million, I'll just go back to my slide quick. This is where most of your premium is going. Any profits that you make, again, they're yours to keep. It does make you more attractive to the insurance market for some of the reasons I touched on. It insulates insurers from those attritional losses, the high frequency, low severity. It gives you a much bigger profile. So again, it makes you attractive purely from a premium perspective. But also, again, the model works. It gives them efficiency as well. And then more importantly, it gives you, it should allow more control over how losses are paid. I'm sure many of you have been in instances where your insurance company has paid a claim for liability, for instance, that you did not agree with. You didn't think it'd be paid, but the insurers did it because it was just cheaper to get rid of it. This gives you more discretion, more control, potentially of how those losses are paid. So that's some of the pros, some of the advantages. And again, not an exhaustive list, but some of them. On the flip side, though, what are some of the cons, some of the disadvantages? Definitely increased administration. That might not be a con, but for some, they may see it that way. So as we mentioned, Reciprocal is a licensed insurance company. So with that comes financial reporting, licensing requirements, an attorney-in-fact role, claims service has to be resolved somehow. Smaller spread of risk. So again, as a reciprocal, your members are pooled together. So instead of being one municipality in a book of business of hundreds, you're now grouped with one. So that means the one for all for one approach. So potentially you could have a group of 15 municipalities subscribing to this reciprocal, and one or two of those are really having lots of claims and helping to drive your premiums up. That is the nature of a reciprocal. That can happen. There's things that a reciprocal can do to mitigate the impact of that, but it is a risk. So you need to go in eyes wide open that it is one for all for one. So I've mentioned on the other side that profits can be generated and retained by the reciprocal. But it's also important to structure that correctly so that your funds are not exhausted quickly and easily by having an inefficient structure. And again, actuaries will kind of dictate where that would be. And then learning some lessons from, say, OMEX, for instance. Some of you may have had experience with that in the past. It requires a long-term commitment. Don't think of a reciprocal as a short-term solution to a short-term market cycle dynamic. Think of it as a 3 to 5 year plan at least that you want to grow and sustain it and build into the future. It shouldn't be seen as access to cheap insurance. It should be seen as a way to mitigate hard market cycles, smooth out the volatility, and hopefully give you budget certainty, because we'll smooth out some of those peaks and the troughs. So again, some of the cons. So in terms of next steps, what would it look like to even begin the formation of a reciprocal? So I've just put here a very quick and basic roadmap. If you're wondering here what ARF is, this is alternative risk finance, and we help to provide that training if you went that way. But that's roughly, again, what the roadmap would look like. So in a nutshell, it's a high-level summary of reciprocals and how they've been used and how they can be used in the Canadian public sector market. Feel free to ask any questions. My details are on the screen, as you can see. So again, if you think of anything afterwards, please feel free to reach out. But with that, I really appreciate you indulging me this afternoon, and Jeff as well, and open the floor to questions.
All right, so if anybody has any questions, you can use the chat function in the bottom or raise your hand and can bring you on screen here. And I will get us started with a question. So reciprocals then ultimately can help reduce your premiums, as you mentioned. But what if so you start, if you have a number of municipalities that buy into this reciprocal insurance, and then the market, I know you're saying you're trying to avoid them even having to be in that wave, but then what if, we hit that soft market again, and then that's more attractive? And is there a risk then of some of your players, municipal players, and trying to draw out of the reciprocal to then go and take advantage of whatever is happening in the soft market? Like how do you avoid that risk?
Yes, a good question. That is a real risk. So a reciprocal requires a subscriber agreement. So that's the contract between the reciprocal and the subscriber. So that's the terms and conditions. Where we've seen this be successful in the past to avoid that issue you mentioned, Andrea, is that the subscriber agreement includes a notice period, so that, for instance, you have to give 2 years notice to leave. So that means that you can't just jump in and out and use it just to get cheap insurance. But it would be important, if you decide to go ahead, that in the formation of the reciprocal, the potential interested parties understand that going in, that they're in this for the long haul, and by doing that in and out approach, it undermines the performance and the future of the reciprocal. So going in with that in mind, on the same page, is the best way to do it. But again, you can do it by contract and just install a notice period that precludes you from doing that, essentially.
Okay, perfect. And looks like Erwin here has a question.
Yes, thanks very much for the presentation. Actually, a lot of it, most of it's over my head, so to speak. But in terms of the makeup of the communities that would make up the group, so to speak, I'm having the feeling that if you're basically a rural community without a town center, would it be better off to have the group that is sort of like-minded in the makeup of the community, as far as, you know, the type of community, size-wise, claims that were already, you know, put against municipalities, you know, like say, instead of saying having a large city amongst a group, would you eliminate them, or would they be a part of any group?
That will ultimately be your call as a NOMA board, if you went that way. There's positives to having large members in there. It does help to bring premium, which is scale, into the fund. But there's also a risk to that. You know, Martin touched on too, and again, a point I agree with. There's not a great deal of value for a large municipality to join a reciprocal. That they can get a similar deal by themselves. They're big enough to do so. But at the same time, one thing that a larger municipality cannot guarantee is avoiding the highs and the lows that we see through the market cycle. A reciprocal should do a much better job of managing those peaks and troughs. So it might not be attractive from a short-term perspective in that the premium difference is negligible, but in the long term, that's where they'll see the benefit, is that, again, we've compressed the ups and the downs, and it's just more consistent, more predictable, and better. Again, you guys know better than me. You know, Martin said, insurers don't like surprises. Municipalities do not like surprises either. So it's a way to help manage that.
The one thing if you don't mind, you know, that one slide that Martin showed about the price increases that some of your members have seen recently, you know, that's something that you'd want to, you know, have front and center for that when the market does become soft again, to remember those times when you are seeing 40% increases, 50% increases, because, you know, staff might change, council might change, but, you know, this is a cyclical. It's very cyclical, right? So it happens again and again. It's not like it just happens once off in one person's lifetime. It's always going up and down. So you have to remember that, yes, the stock market does have its benefits and it does come around every once in a while, but also the hard market comes, and that's what's really, you know, that's what's causing the problems. It's not the soft market that causes problems for budgets and everything. It's when the hard times hit. So having the reciprocal in place will smooth that out. And it's a matter of, yes, maybe for a couple of years, the soft market could give you some premium savings, but in the long term, you'd want to have the smoothness of a reciprocal to hopefully allow your budgets to be, you know, pretty much normalized, as opposed to, you know, 40% increase this year and a 20% decrease next year and things like that, right? So it just helps for your budgetary planning reasons. And then also just having the same type of members in reciprocal with you can allow for some risk management and risk control processes that can be learned between the different communities. So, you know, if you do have, you know, similar roads, similar, you know, trip and fall areas, things like that, where you can learn from each other to hopefully reduce the claims. And as Martin said, you know, there was a question about, you know, how can municipalities reduce their premiums? It really does come down to claims and risk control. So, you know, if you do have an insurance broker or MGA that you're working with, the focus for municipalities should be really to see how we can reduce our claims and what can our, you know, broker or MGA do to help us with that. So it shouldn't be a matter of you pay your insurance premium and then you don't hear from your broker for the rest of the year. You want to be actively involved with them to see how you can better learn best practices that are out there, because ultimately the lower amount of claims that you have, the better you'll be rated. So doing everything you can to protect yourself and, you know, doing things that will protect your community members as well and the taxpayers is never really a bad thing either, right? So hopefully you're doing something to decrease your premiums while at the same time making your community a better and safer place to live as well.
I agree with that, Jeff. One thing to add with regards to the size, nobody's too small to join a reciprocal. I think there becomes a point where you're too big to receive the value, as we mentioned. But if I give a real life example, one of the reciprocals that I work very closely with, their largest member is a county with 90,000 population, but they are by a very wide margin the biggest. Most of them are between 2,000 to 5,000, but they go down as small as 25 people. Some are villages. So again, the 25 population, I'm struggling to describe it then, it was so small, but the 25 population Summer Village has been a member of the reciprocal since its formation, and obviously, yes, all the benefits that we touched on, access to the greater buying power and so on, they weren't too small, in other words.
I have another question. Do you, either of you or Jeff, aware of any data that has been done to actually look at the like a long-term example and to see what the actual cost savings would be to have a reciprocal versus going through the soft hard market? Like obviously there would be, I can't even begin to explain the math that would be involved with that, but if you know what I mean, has there been any data sets on that to kind of to do a very numerical pro-con?
What I could commit to, and it shouldn't take too long, because I can, so we've got a long list of clients that operate reciprocals. We could certainly show you their performance, you know, whether rates have tracked over the last, say, 10 years. It does get a little bit misleading though, because the reciprocal, when we're funding the aggregate, and I use the 2 million example, so I'll just use that to make the point. In some years, that 2 million could increase to 4 million, and other years down to 2. That bit doesn't matter. That sounds like we've increased by 2 million, doesn't it? That doesn't matter, because if you get the credit on the premium, it comes out in the wash. So what I'm saying is the total cost of risk, so the aggregate plus the excess premiums, is the bit that really matter. Because when you receive your premiums from your members, you allocate a portion for the reciprocal and then some for the excess. It's just an allocation exercise. But we could certainly show total cost of risk for the last 10 years for, you know, 4 or 5 of those examples. And I'm confident that it would fare more favorably than what you've seen in the regular open market with, you know, these sudden spikes of 40, 50, 60%. I'm almost certain it would show that.
Okay, perfect. And that would also, I'd need some data from municipalities on what those numbers have been for the last, you know, 10 years to actually see that cycle too, and then compare those numbers. Okay.
I can get that data. Obviously, it would be anonymized, but if I could assist in any way with at least providing introductions to those reciprocals, and you can have a, you know, your own private conversation, more than happy to assist with that as well.
Wonderful. Thank you. Did we have any other questions from our audience here? I don't see anything in the chat. I do have one final question on my end. So we've heard about these cash calls or retro assessments. How can I avoid these for the municipality?
Good question. So when you're deciding how much the reciprocal should be, so the per occurrence amount, the aggregate limits, all those kind of things, that's an actuarial calculation. So what some clients will do is they'll take the actuarial number and say, we'll fund whatever the actuaries say that we should. If I understand correctly, that's how other municipalities in the past have got it wrong, because actuaries only look backwards. They don't look forwards. They try and make predictions looking forwards based on the past. If they get it wrong now, and you could have one large loss that skews those numbers. So they've not collected enough to pay for those claims. So they have to go back to the membership and say, hey, we got it wrong. we need another few $100,000. The other way to do it is to say, my aggregate is 2 million. I'll fund the 2 million. So once we're paid out, that's when excess insurance comes in. There's no risk of a cash call or retro assessment in those instances. It's a matter again that NOMA as a reciprocal board, again, if you get to that point, will decide we're going to take the actuarial numbers and we'll fund that, or we'll fund the maximum exposure that we have as a reciprocal, whether it's $1 million, 2 million, 5, 10, whatever it is. But funding to the aggregate is the way to avoid the cash calls and the retro assessments.
And I do have one more question, just to back on that now. So instead of, say, NOMA taking the reciprocal, would there be, what would another option be? Would there be another option for someone?
Potentially, I know there's conversations around the formation of new pools and buying groups within the province right now. They're all at different stages of maturity, so I don't think anything's been close to being launched yet, but it could be that, you know, a group of closely, geographically close municipalities say, hey, let's just do this ourselves anyway. NOMA's taking too long, or NOMA doesn't want to do it, but we see value in us as a smaller group, you know, taking that initiative. So that potentially that would be an option.
Perfect. Thanks, Chris. Gonna give final call for some questions here. All right, seeing none. Well, I feel like I'm on a council. I think that would conclude our learning morning, our first. So thank you, both Chris and Jeff, for joining us today. I really appreciate you participating and giving us a little more of a deep dive on the reciprocal end. Also, for those that are still with us, we are looking to host another one sometime in the fall. Not sure when yet, but we'll see once we get closer to. But if you ever have any topics that you would like to learn more about, please just reach out and send me an email, and then I'll try and get someone together that can speak to it in the future. So I'd like to thank all of our presenters today, really appreciate it, and everybody for joining us and asking some